Okay guys, welcome to the 2025 Mentorship. This is going to be episode 1, an introduction to open high low close and open low high close concepts, or basically just every candlestick in the market, bullish and bearish, power of 3, AMD, whatever you want to call it. Okay, I'm going to try and keep this introduction as short as possible since I recorded this a week ago and I got some technical issues. But there's not a lot to unpack. Throughout the course of this mentorship, I just want to show you how I view the market, teach you the concepts that I use, and not necessarily teach you a strategy or a model. There are plenty of models you can use in my free Discord. I've taught plenty of models, I've traded plenty of models live in front of you guys, for those of you who have been watching me trade for the past couple of years. So for this mentorship, I just want to show you the things I use on a daily basis, the way I think about price and specifically about time as well. And I want you to take that and then just develop your own model, right? You can obviously reach out to me and we can do it together. We can collect the data, we can put all the pieces together to suit your personality or your lifestyle, whether you have a job or not, or whatever your routine is, and we can just take it from there. This is going to be my last mentorship. I don't think I'm going to put out any teachings, so to say, after this mentorship, so I'm not sure how long this mentorship is going to be. I will still release videos here and there, but it won't be in this sort of format. Okay, so let's get into it. Things we'll be covering in this introduction episode will be the importance of open high low close or open low high close. We'll be focusing or touching on time and price. There will be episodes in the future where we dive a bit deeper into time as well as price individually, how it's all fractal and the importance thereof, the simplicity of building a model around open high low close or open low high close times and prices, and then we'll go over AL60 or model 2025. And just a shout out, so AL60 is taught by the Hunter Setup. You can follow him on Twitter, check him out on YouTube. That is the source for AL60. Okay, you're not going to find it anywhere else. So the importance of open high low close or open low high close, it's every candle you view on any time frame that you can think of, whether that's a 3-second chart, a 5-minute chart, a daily chart, a 13-minute chart, right? There's always open high low close for bearish candles and open low high close for bullish candles, always, right? And that's very important to acknowledge, simply because if you understand the draw on liquidity, for example, if you know where price is going to go, that's all you need. From there, any entry pattern with time obviously will work. Any model, any system, any whatever, it will work. Whether you know where price is going to go for the next year, for the day, or just for the next 15 minutes, if you understand where price is going to go, you have a model. You understand the draw on liquidity. There's obviously an expiration on it. Say for example, you understand or you know that the draw on liquidity for the next 15 minutes is to the downside, right? You could simply get on a 15-second chart and mark the opening price of the next 15-minute candle, wait for price to go above open and look for shorts, because you know the draw on liquidity for the next 15 minutes is lower. Does that make sense? And if you can do that on one time frame, you should be able to do it on any time frame, whether that's a yearly, a monthly, a weekly, a 1 hour, 4 hour, 3 hour. no matter the time frame, you should be able to do that, because it's all the same thing, right? The only difference is when we dive into time and price, and we see certain signatures, certain things happening at certain times, right? At certain times, at certain prices, okay? Because it's all fractal end of the day. Okay, there's, for example, let's use a retail concept like Head and Shoulders. If you see, and you can view a Head and Shoulders with 3 candles, you understand? Let's take 3 daily candles. The middle one having the highest high, the one on the left and to the right of it having lower highs, basically. The first one being bullish, creating the high, and then closing out. The second one going down and then up, putting in a higher high and then coming lower. And then the third one going up, putting in a lower high and then pushing bearish. 3 candles on the daily chart, and you go down to like a 15-minute chart, and you'll see that Head and Shoulders unfold. And inside of that, you will find other Head and Shoulders 3 candle patterns, and inside of those 3 candles you go on a 15-second and you'll see the same thing again. You know what I mean? And that's what I mean when I say it's all fractal. The picture looks the same, not exactly the same, but it looks the same. Sometimes it happens really quickly, right, over a short period of time, or I shouldn't say a short period of time, in fewer candles, I should say, because the time is relative, right? Sometimes it happens in fewer candles, sometimes it takes a bit longer, but it's more candles, and that's all because of time distortion, right? Sometimes it can take 5 daily candles to form, and other times it'll take 2 daily candles to form, right? But the picture is still the same. It's just how many candles it takes to do or to paint that picture. And the other difference is in time is the speed at which certain things happen, or how long it takes for something to happen, right? If you are trading 15-minute candles, for example, these things are going to happen really quickly. So that comes down to who you are as a trader and as a person. You know, if you have a job, it will probably suit you to trade higher time frame candles, like the daily candle or the weekly candle. You'll have less opportunities, less positions, right? Less trades, but you will have less screen time. So it might benefit you a bit more. You'll probably be more successful that way. If you have more free time, on the other hand, you could probably trade a few hourly candles every day, if you understand the draw for the next hour or for the next 2 hours, right? So it all depends on your lifestyle and your personality. If you are a more patient person, I think the weekly candle is a really nice candle to trade. And if you are less patient, I think 15-minute candles are pretty good. Hourly candles, 3 hourly candles, those are perfect. You can enter on the 3-minute chart, the 1-minute chart, or the 15-second chart, depending on what kind of scalper you want to be, right? So it's all fractal, and you shouldn't underestimate the power of understanding that fractal nature and how it's the same picture regardless of how long it takes. You know, when I started trading and someone said you need to use the higher time frame, my mind always went straight to daily chart, 4-hour chart, or weekly chart, you know. And the way I see it now is, well, higher time frame, it's relative. Like, what's your lower time frame? If your lower time frame is your 1-second chart, your higher time frame is not going to be the daily. Your higher time frame is going to be a 1-minute chart. You understand what I mean? Like, it's all relative. So you need to understand the importance of the market's fractality. Once you understand that and pair that with knowing where the draw on liquidity is for whatever amount of time, right, you'll be unstoppable. You'll be able to trade any market, obviously paired with specific times of the day. Okay, and that's how you build a model. You know, you choose a session you want to trade. You find a pair that has volatility in that session. Let's say London session, for example. Let's say you're not busy during London session. That's when you want to trade. You're going to take something like GU or EU, you know, a euro pair or a pound pair. Let's say you want to trade Asia session. You can take something like UJ or GJ. You know, GJ is even better because you're going from JPY's banking hours straight into London's. So that volatility is there, you know, consecutively. Instead of UJ, for example, where we have volume in London, in Asian session, and then there's a short little break, and then you get volatility in New York session again. Obviously, it's all up to you, but once you choose your session and you study that session only, you understand how the OHLC or the OLHC works. You understand how the power of 3 works. Let's say the session you chose is 3 hours long. You can look at that from a 90-minute chart split into 2 candles, or you can look at it from a 45-minute chart, right? Looking at it in quarters, or you can just look at it as one candle, one 3-hour candle with open, low, high close, open, high, low, close, and use the previous price action as your draw on liquidity, or your liquidity in general, or your PD arrays. Right, that's how you build a model. Then you study those 3 hours every single day. You backtest those 3 hours only. You get your data from there. You understand when the high or low is going to form. That's where time comes in. And if it's in Q1, then you understand, okay, after price opened up, are we going higher or are we going lower? If we are going lower during Q1, it's likely that it's going to be a bullish candle. You understand? You obviously need to study how many pips or points does price go up or down when putting the high or low in during Q1, during Q2. How far does it distribute? You know, and this is where the data will come in. Okay? So it's very simple, it's very easy to build a model. It all comes down to sitting down, asking yourself, when do I want to trade? Which pairs go hand in hand with that time of day? Okay, and then sitting down and actually just studying that pair, studying price, studying time. Okay, and once you have that on lock, it's just a matter of time before you master that session. It's not going to be 100% obviously, but like I always say, if you are a 2R minimum trader, you just need a 50% win rate, right? If you're risking half to 1% per trade and you get 2 trades a week, you're making 1% a week, which is kind of crazy. That is a lot. That is way more than the average trader. So you just need to put the work in basically at that point. But yeah, if you have any questions regarding building a model, like I said at the start of the episode, just message me on Discord and we can start somewhere and we can get the data together. Okay, let's dive into AL60 real quickly. I'm only gonna dive into AL60 once because it's all over the Hunter Setups YouTube and his Twitter. So if you want to learn more about AL60, you can go and check him out, check his content out, or you can refer to one of the models in the Discord. And alternatively, you could also check my live streams on YouTube where I use AL60 for most of my entries. Okay. So here we go. I'm gonna ask you to pause the video and just write down what you see. Okay, write down what you see, write down which moves you would trade, and then I'm gonna dive into candle flips. So just pause the video, write down what you see, and which moves you would trade. The first thing I see is that price is bearish. Why would I say price is bearish? Because you get a big distribution to the downside. We leave bearish inefficiencies, and we get a slight pullback, and then price, by the looks of it, is starting to go lower again. Okay, so what do I see? I see bearish market structure, bearish impulse. I see a pullback to the upside, and I see the potential of another push to the downside. Now, which moves would I trade? There's two setups I see in here when using OLHC, of course. Okay, and before we dive in, OLHC is simply a two candle theory. You're viewing a market maker buy model or a market maker sell model. You're viewing a sell side curve and a buy side curve, and vice versa between two candles. It's two candle theory. Okay, that is all it is. It's a bullish candle followed by a bearish candle, and vice versa. And that's where candle flips come in. So the moves I would trade would be the first bullish candle after that bearish one, and the first bearish candle after the last bullish candle. Those two. And these are candle flips. Now, I recently coded an indicator to point out candle flips. I could release it. I kind of don't want to release it until I add a few more features, but if you want me to release it, I'll release it. Open source code. Yeah, it's just nice for when you're looking for, backtesting basically, and you're going through a 1 hour or 3 hour chart, and you're just checking, oh, here was a candle flip at this time. Let's see, the day before that, there was a candle flip that time. And you just collect data that way, and it's nice and easy, instead of having to look at every single candle, But yeah, these are the two candle flips. These are the two trades I would take. And with OLHC, you get in and you get out within the same candle, right? Throughout this entire course, that's how it's going to be. If you're trading a daily candle, your expiry for that trade should be end of day. If you're trading a 4 hour candle, let's say the 9 a.m. 4 hour candle on Forex Base, you need to be out by 1 p.m. when that 9 a.m. candle closes, right? Getting back to OLHC and these two trades I would take. OLHC, you are looking inside of the previous candle's wick. So let's look at the first move. If we have a down close candle, right, and we understand, before I go further, we understand price is bearish. So obviously we only want to take sells. But let's assume we do not trade with the trend and we're just looking to trade every single candle flip that we can get. After that bearish candle, let's say we are finally entering our session and we see the previous candle was bearish. We are going to mark from the low to the closing price of that bearish candle, and we are going to look for longs inside of that. Now on the opposite end, we understand price is bearish. We have just entered a bearish inefficiency over there, and I will mark that out for you. And we are going to look inside of the previous bullish candle's wick from the high to the close, as I've marked here. Right? Now price is allowed to violate that. Okay? That's completely fine. We have a Fibonacci retracement tool with specific settings that we want to see price tap into. Okay, that is model 2. Model 1 would be if price does not sweep the previous candles high or low. Okay, there's that inefficiency. Let me show you the fib settings. There you go. So as you can see on the first setup, we are basically splitting the down close candles wick into quarters, and we want to see our longs form inside Q2 or Q3. If we violate Q3, right, looking at the first setup on the left hand side, if we violate Q3, we should see price take the previous candle low out. And if that's the case, we want to see a tap into the rest of the deviations, as you can see on the second setup, where we actually take the high of the previous bullish candle out and we tap into the 3 blue lines above that. Let's look at a live chart. Let's assume we trade the 10 a.m. 1 hour candle, which is the silver bullet, right? Great hour to trade. It's obviously gonna have its days, but great time to trade, great hour. And that will be the bearish candle right over there. Obviously we wanna find the draw on liquidity or the trend first, but let's assume we're trading the 10 a.m. hourly candle. Here you can see, yes, 34 candle flips in this picture, right? You can pause and you can count. There's 34. Okay, the time frame we're on is irrelevant, right? But there's 34 opportunities to trade. Now, we wouldn't take 34 trades. Okay, that would be insane. Whenever we look at a market through the lens of OHLC or candle flips or reversal points, right? There's so many things you could call it, because OHLC is just a reversal point. You go on a lower time frame, and we'll get into that in future episodes. You'll start seeing it, it's all fractal. And then you're zooming out and you see it again, you're zooming in and you see it all over the place. And it's just everywhere, and OHLC, if you look at OHLC through a microscope and you take your eye off, or you take the lens off, you see OHLC again, and you just keep stepping back and you just keep seeing OHLC form. That's actually crazy. It makes you think of time being circular instead of linear. So it's very interesting. But that just goes back to how the market is fractal, right? How smaller images being painted on smaller canvases are just painting the same image on a bigger canvas, right? But yeah, 34 candle flips. This will obviously be put through a filter. Let's assume you're only trading New York session. You will probably only have half, if not less, of these opportunities. Let's say in New York session, you are only trading with a trend, you will lose another half, right? So now you're left with more or less 8 opportunities. Let's say out of those 8 opportunities, you only want silver bullet setups. There'll only maybe be 3 or 4 setups, which is fine, right? That's what you want to do. You don't want to trade every single OHLC that represents itself, or that presents itself. Okay, that will just lead to you over trading, over leveraging, taking losses in places you don't need to take losses. Like I said a few moments ago, if you focus on one specific time and master that, you will do way better for yourself than trading NQ during Asian session and then trying to trade London and then trying to trade New York as well. Okay, you need to focus and you need to journal. And you don't need to lose money for this, by the way. You could just back this, just put the work in. Just write down your findings. Here we can see, like I've mentioned, let's assume we are trading the 10 a.m. hourly candle. I've slapped a simple moving average with a 15 period, I think, just so that we can see the trend. Right? There's many ways to see the trend. There's a market structure shift, we are inverting bullish fair value gaps, we are creating bearish ones, we are respecting bearish order flow. But let's say you don't know how to do any of that, just slap a moving average on there and you can see price is bearish. You can slap some trend lines on there, whatever you do. Okay, the trend is bearish. I've pointed out the 10 AM candle that we want to focus on, and like I mentioned, OHLC is a 2-candle theory. In this case we are bearish, so what do we want to see? We want to see bullish candles, we want to see up close candles. Why? So that we can slap the fib on that wick from the high to the closing price, like I've done over here. We want to see price enter Q2 and Q3 of that, and if we take the previous candle's high out, we want to see a tap into 1.049, 1.050, and we do not want to see it exceed 1.05096. Okay. There you can see the fair value gap pointed out, which is lining up nicely with 1.048 and 1.04870. Here we are on a 15-minute time frame now, and you can see there's another inefficiency right over there that was tapped into during the previous candle, during the 9 AM candle. So these are just things that are adding confluence to your short bias or your narrative for price to go lower. And here we are finally on our entry time frame, which we get to by dividing by 60, by the way. So if you are on a 4-hour chart, you should technically be on a 4-minute chart, I think, but 5 minutes perfectly fine. If you're on a 60-minute chart, you want to enter on a 1-minute chart, etc., etc. So as you can see over here, I've marked out 10 AM opening price, and you can see when price comes into Q2 of that fib, I don't want to see a wick. If we get a wick, I want to see the wick at least tap consequent encroachment of that fib or of that previous wick, which is the midline at 1.04870. Other than that, I want to see body closures. Okay, specifically body closures leaving inefficiencies as well that we could invert, right? There's multiple things I like to see, but the main thing is body closures. Once you have a body closure, that's your confirmation. Okay, now all I need to see is another flip. All I need to see is a change in state of delivery. All I need to see is an inversion fair value gap being created, and then supporting inefficiencies with current order flow, in this case bearish order flow. So I want to see bullish fair value gaps be disrespected, and I want to see bearish fair value gaps being created. I want to see a balanced price range. I want to see previous lows getting taken out. I want to see, all these things. These are things you want to see. You don't need to see all of them, but this is what would go through my mind after we get those body closures. Okay, and sometimes price will give you a body closure, give you an entry and stop you out, and that's fine. Okay, sometimes price will give you that body closure and just keep going up and you won't get an entry. That's fine as well. Sometimes price will wick into the fib and not touch consequent encroachment, right? So you just want to be patient and take the high probability setups. Okay, just because you take less setups does not mean you will be less profitable. Okay, in fact it might mean the opposite. So yeah, I've marked the opening price, I've marked the high, the low, and the closing. Okay, and as you can see, we get the body closures, and right after that we create a bearish fair value gap that price wicks into. And before that, we got a down close candle below the opening price of the bullish candle that closed inside of there, which is the change state of delivery. Okay, if you don't want to trust that, then there's a market structure shift as well. You see that short-term internal low? As soon as we close below that, we create a bearish fair value gap below the fair value gap that's in the premium of that first bearish leg. after the body closes. Okay, so there's multiple opportunities for you to get in here. Stop loss at the high, and that's your open high, low close. Another thing to consider are the timings, but we'll get into timings in the next episode. But you want to think of each candle or each session you trade, and split it into thirds or quarters. And then understand, okay, in Q1 we are likely to do this, in Q2 we are likely to do this, in Q4 we are likely to do this. And that's how you want to think about price. You always want to consider time. Okay. So let's go over what you learned in this episode. You learned the importance of time and price within open high low close and open low high close. You learned about the fractal nature of Power of 3. You learned what AL60 or Model 2025 is. You learned how to spot and trade the model on any time frame. And you also slightly touched on it, the use of PD arrays, macros, and kill zones as a confluence to the model, which I will touch on a bit more in the next episode. Okay. If you have any questions, leave it in the comment section or send me a message on Discord, text me, and we can go over some charts together. Okay. Because the one thing I don't want you to do is watch these episodes and not make any progress. Okay. There's a reason I'm doing this mentorship, and like I mentioned, this is the last mentorship I'm going to do. So I really want you to take it head on, take it seriously. If you're not going to take it seriously, then I would say it's best you just not stay for the remainder of the mentorship, just because it's going to get a little bit more advanced. And I'm not going to teach you a model, but more so the concepts that I use on a daily basis. So you need to make the decision. Am I gonna take my trading seriously? Specifically especially if you're not profitable as of yet or consistently profitable. You need to ask yourself that question. And then if the answer is yes, you want to take this seriously, then definitely watch the next episode, right? If you're unsure about how the mentorship's gonna go, like I said, just send me a DM, message me, and I'll send you a breakdown of the entire mentorship, because I already have it all planned out. So yeah, that's gonna be that for the first episode. The next episode will be going over time specifically. It's a really good episode. It took a week for me to plan it properly. But yeah, until then.